Okay, guys. Welcome to another another session, another lecture, another class. Now, before I proceed, for some of you or those of you who are having a tough time probably seeing my annotations and those things I draw in front of the screen, it's visible. You just need to increase the video quality of your YouTube. So just go to Google and ask how to increase the video quality of YouTube videos, like the one you're watching, and follow the instruction there. Okay. And or you can just click on the settings on the video you're currently watching, go to advanced, go to quality, and then put it to the highest quality, and you'll be good. Okay, this is because sometimes the annotations are usually very tiny, especially when I'm referring to weeks. You might not be able to see those things I'm pointing out if you are managing data. So it's important that you budget for the class. Okay, so that what's it called now? So that's it for that. Let's let's start what we're here to do now. Um, this will be the last series of classes that we'll be hosting, and after this series of class, like I told you guys, yeah, after this series of class, we would maybe the videos I'll be dropping with the videos, instructions, guidance, and all those things and probably just pick one or two questions and make a video about it. But for now, we are still in class. We're still learning. Uh, and in our previous class, I was able to speak about, the reason why price is continuous. Price does not break. Those things you call structure because of time frame. You understand? So time. So all these pullbacks, consolidation, all those things. Price don't do those things. In the real sense of price, price don't do it. Price just moves in a straight line at the back end. Okay, price 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 flows. Okay, in a way, it follows the majority of the order. And then I taught you guys that, and I was able to prove that using different candlesticks as theories, and you know, and then at the end of the day, I told us that in the market business model, how we can know how we can know where price is headed to next is by using what I call the anchor candle, and that was where we stopped in our last class. And we are going to pick up from there. I want you guys to know that those videos are this is a concept. The market business model is a concept. I could practically just come on YouTube and just give you guys the strategy. Just give you the strategy and tell you when you see this and you see this and you see that, this is what you should do, which would be easy. I mean, it makes sense that way. But the truth is, this is why majority of traders fail woefully, despite paying for mentorship. Most of the mentors or the tutors, that is what they think it is all about. Meanwhile, that's not it. You should help the students acquire understanding, no matter how long it's gonna take. This market is not a place you can just come and just do abracadabra and you expect money to come out. No, sometimes you'll be lucky, but we want to remove luck based on chance out of the equation. We want to be lucky based on what we have. We want to be able to program this thing to work for us. That's the reason why I am teaching you guys. That's why this lecture is taking time. And moreover, the market business model is a component. It's a compendium of several knowledge that delivers different results. So if you want the result of a swing trader, There is a body of knowledge in MBM that covers it. If you want the result of scalping, day trading, position trading, the if you there are body of knowledge that covers them. So and I know that all my students can definitely not be the same. While I teach you that when you see a candle break a previous candle break price clearing a previous candle level, you expect some things. Some of you will definitely configure it to suit yourself. For some people, they will prefer to wait for the weekly candle, high and low being cleared. Maybe because of their work schedule, maybe because that's how cool they are, maybe they are that patient. Some people they will prefer the daily, some people will prefer the 4 hourly, some would even prefer the 15 minutes. The point is that at the end of the day, all of you are making money, regardless how you tweak it to suit yourself. That's why the market business model traders, they all trade. That's why, like I said, we don't trade patterns, we trade logic. So the things that somebody who is on the one on the weekly time frame is doing, somebody on the 15-minute time frame can do it using a body of knowledge that have been taught to them. Different time frames, different approach, different strategy, okay, but the same ideology, the same concept. So if I teach you this, uh, we also have to consider a lot of things. I can't just come here and just tell you guys, oh, just open your mouth and just start pouring strategies that you don't even know how I was able to come up with them. Strategies that you can't even vet. You can't check if truly this is it or not. So it's better we take this long route of building understanding for the market business model. Yeah. And then when we take this long route, at the end of it, you know every single decision you make in the market, you know it. And when you make mistakes, you know the mistakes you made. And when you make profit, you grow from there. As far as the market business model is concerned, it does not fail. It doesn't. The only failure you will experience as a market business model is the flaws of humanity. Normally, me personally, I still take losses because sometimes I don't pay attention to some of this level. Sometimes I pay attention to a level and I forget to see the other things that are attached to it. Okay? Sometimes I've already entered the trade before I see the mistakes. But overall, I am still profitable because I found a way because MBM in itself is efficient. So it's a compensation for my flaws. What you trade will be a compensation to your flaws as a human. That's why everything you'll be learning in the market business model so far, there are things that you can trust because they are things that they're not just things that I just cooked up, that things are already there. So in tonight's class, we're going to talk about the anchor candle. Our focus from here on now is going to be on in the previous lectures I've taught you about reversals and all those. We'll still talk more about reversals, but let's talk about we are focusing on understanding price continuation. And for us to understand price continuation, I spoke about something called the anchor candle. Now I'm going to hide this down. Now you see the the thing we call the anchor, ANCHOR, anchor candle in the market business model cannot be understood if you don't understand some other things. Hmm? It's like saying you want to make what was the popular what's the popular meal I can use now that's in the world. I mean, it's like saying you want to make donuts. Yeah, good. Let me use donuts, for example. I mean, everybody knows donuts, even if you are not in Nigeria. So it's like saying you want to make donuts, or you even want to make a soup. For you to make a donut, you must know what a flour is. You must know what sugar is. You must know what I don't know if they add yeast to it, but if they add yeast to it, good. You must make what know what baking powder is. To make the dough, you will need water and every other thing you want to, to use to garnish up your donut. At the end of the day, the focus is the donut. But there are things that you combine together to make that donut. The same thing for soup. For a soup, so something to become soup, it needs pepper, it needs tomato, it needs fish, it needs salt, it needs seasoning, it needs spices. All these things are what you add together to make up the soup. The same thing for the anchor candle. You can't understand the anchor candle if you don't understand some things. It will be very difficult for you to prosper or to make money. You will just, you will see some things, you will think it is an anchor candle, but it is not. So it is your understanding of what makes up an anchor candle that helps you know that, okay, this one is an anchor candle, this one is not it, even though it looks like it. Now, for us to understand this anchor candle, we'll need to now drop. You see, everything I've talked about, just keep it one side. Let's keep this anchor candle one side. Let's keep it. We have to start from a fresh pane. Start from a fresh place. So let's leave this one. We'll come back to it. Because at the end of the day, everything we are doing will still direct us back to it. We'll still come back to it. But let's build understanding for things first. When we build understanding for things, it will be very easy for us to understand what I'm referencing as anchor candle. I hope you guys get me. Good. Now, you see, every time a candle is created, remember in the MBM we focus on price, and the best way we can represent price is through candle. That's why most of the times, most of the things we do is candle, 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 candle. You're not, we don't, I don't, we don't, there's no arbitrary point. You get price is our focus. So the moment I draw a candle, it means I'm talking about 4 price points: open, high, low, and close. Open, low, high, and close. So you get what I'm saying? Good. Now, every time a candle is formed, there would be a high and a low. Now, our attention is on this high, yeah, and this low. For us to understand price continuation, we must understand the high. Sorry, let me do that again. We must understand the high and the low. The low. Now, for us to understand price continuation, we need to understand what? Highs and lows. Good. Now, for us to now, please don't be confused. For us to understand continuation, we must understand what? Highs and low. Now, for us to understand highs and lows, we must understand something we call swing. Swing, SWING, swing. So our class today will be focusing primarily on swing. Now, a swing point is made up of a swing point is, a point where price reverse to the opposite side. In market dynamics, or fundamentally, a swing point is that point where volume gets transferred from bidders to askers or askers to bidders. Now, in a swing high, volume gets transferred from, in a swing high, in a candle high, what happened is that, based on what I've taught you guys, I said at a candle high, what do we expect? We expect to see price, you know, go up. That means bidders in control, and then askers clears that level that the bidders, they buy into the liquidity of the bidders. Yeah. So bidders were the one that created the expensive price. Sellers feel like it's expensive enough, and they sold into the liquidity provided by these guys. Now, this point here is what we call a swing level or swing. That's what we call a swing. But then this is just textbook explanation. What exactly is a swing? A swing is made up of three candles. Okay? A swing high is made up of three candles. First, a bullish candle, that is, a bullish candle, a, a bearish candle, and another bearish candle. So I'm just going to bring that up here. And another bearish candle. So basically, sorry, this one should be here. Now, basically, I'm just gonna put, let me make this one Y, let me make this one, let me put another color on this one so that you guys can understand this. Now, this is a swing high. Bullish candle indicating, now why do we use candle? But candle, why are we now paying attention to candle color? Reason is because normally in the market business model, I told you that we can practically use the same color, which when we get to the part, I'll teach you guys. But you guys are just coming up, so let's follow up, okay? Now, a swing high, like I told you guys, a swing high is made up of a bullish candle, a bearish candle, which is the highest point, and then another bearish candle. Okay? I'm showing you guys something. Please follow up. A bullish candle, a bearish, and a bearish. But then this is what every swing have in common. Every single swing. Okay, every single swing. So whenever you see this kind of move in the market, bullish, bearish, and then bearish, that's a swing. Because if you are looking at this level here on, let's say, on 15 minutes, and you go to lower time frame, let's say 1 minute, you definitely see massive movement, right? You definitely see massive movement, massive movement. What is small to you on this time frame is actually a trend on lower time frame when I taught you guys price fractal. Okay, I'm trying to zoom out what is at this level here. We are going somewhere. So for us to understand price continuation, we need what? We need to understand swing. And swing is what happens at every candle, highs and low. Then what is a swing? This is a swing. A swing is made up of bullish moves. It could not be a candle. I'm not talking about candle now. We don't pay attention to candles. We're talking about the move. So you can see multiple bullish candle, then multiple bearish candle that start selling. That's a valid swing. This one is just for text, for explanation purpose. Remember that the market is not the way it is in the textbooks. So, and we don't follow patterns here. That means that the high of this swing, this bullish candle can be the high, while these other candles can start selling, indicating a swing point also. So a swing is potentially a reversal point for price. That is what we call a swing. Please pay attention. That is what we call what? A swing. So a swing high is characterized by massive bidders buying into price and then askers selling into the liquidity provided by the bidders. Of course, a swing low would be opposite of this. So we want to see bearish moves, right? Bearish moves, and then followed by what? This is a bearish move, followed by a bullish move, and another bullish move as confirmation. Just I don't want to just gonna make it like this. Okay. Now I don't want to pull weeks. I just want to pay our attention to. I just want. Yeah, the week is definitely going to be on candles. I don't want to waste our time by putting weeks. But let me put the week because some of you are despicable. So let me just make the week like this. Don't want to waste time. The weeks like this. Same thing for this one. Okay. So as you can see, this is what makes up. So it doesn't matter which candle. Sometimes this candle can be the highest candle in this one particular one might be the one with the high. It doesn't matter the week. What we pay attention is what is happening. We don't care about pattern. Remember, okay? So a candle, sorry, a swing high is characterized by its bullish move. Bidders buying, and then askers filling the liquidity of the bidders, and then a swing low is characterized by sellers, bidders, askers, and then bidders buying into the liquidity provided by askers. Now that we know a swing high and a swing low, what they are, I want you to know that swing high happens at candle high and candle low. Please, I did not say. Uh, See, it's very important that you understand in the market business model, because of the fact that we don't trade pattern. It will require that you have a high level of assimilation, and this would mean that sometimes you might not be able to assimilate something immediately. So it will mean that you come back to it and study it again. That's why some of you, when you watch the market business video, some of my videos, and you jot things down, when you come back, you still be able to jot things that you omitted. Reason is because it requires that you open your heart, you open your brain. Sometimes you need to be exposed to a body of knowledge first before you can understand some things. For example, this anchor candle cannot be understood if you are not exposed to the body of knowledge I am showing to you first. I hope you guys get what I'm saying. So you please pay attention. Very important. Okay. The market business model is the delicacy of the market business model is what gives it the high the high efficiency. So if you don't practice, if you don't listen, you're not gonna win. So please listen. Now that I've explained a swing high and a swing low, and then I told you that a swing high will be found at where? I'm sorry, a swing high will be found at a candle high, and a swing low will be found at where? A candle low. Now, it means that, and remember when I was teaching fractal, I said because you're on the daily time frame, does not mean that whatever happens on the daily time frame is bound to happen on the 1 hour time frame. You can't say because of you're on the daily time frame, that's the time frame that everybody is going to follow. You get what I'm saying? And I also told us that price is based on your position. What is expensive to you on the daily time frame might be cheap to somebody else on weekly time frame. Now, please pay attention. That means that let's imagine this is the daily time frame. That means if I go to every 4-hour candle on the daily time frame, I will see swing high and swing low. And this means that, please pay attention to what I'm trying to explain to you. Let's imagine this is a 4-hour candle. Now, you know this 4-hour candle is definitely inside the daily time frame. This is a daily time frame. This is 4 hour. So this daily time frame will bring 4 hour out. That means this 4 hour will have its own what? Its own swing high and swing low inside the daily time frame. Now, if we go to 4 hour time frame, and we bring out, let's say, 1 hour from the 4 hour time frame, one hour candle. That means every 1 hour candle will have its own swing high and swing low inside the swing high and the swing low of the 4 hour, inside the swing high and the swing low of the daily time frame. And the daily time frame will have its own swing high and swing low inside the swing high and swing low of the weekly time frame. And it goes on like that. Okay, this means that because price clears a swing or price gave you a swing does not mean that it will start selling. And this is why VTB sometimes, VTV and VTA sometimes does not go in your way. So it means that if price clears the 4-hour level, it might not start selling because it needs to create a swing high for the daily time frame. Or sometimes when price gives a swing, when price gives a swing high on the swing low or a swing low on the daily time frame, it might not start buying or start selling because it needs to create a swing high or a swing low for what? For the weekly time frame. Every candle, remember I told you every candle is made up of what? Open, high, low, and close. And since every high and low is a swing point, it means that every candle must have its own swing point created. We are building knowledge for something. Please follow up. So your question is, now that you understand that swings, even though they happen at every candle high and low, it doesn't mean that because of this candle have created its own swing now, it will now start, selling. You get what I'm saying? Because this is 4-hour candle. This is one. Let's imagine this is 1-hour candle, and then it created a swing high. That is transference of volume from bidders to askers, and the 4-hour candle is not yet closed. What do you think will happen? Remember, how many 1-hour candle will make up a 4-hour candle? Four, right? So let's say the first one, the second one, and the third one. This is why you see candle continuation. So let me give you a graphical representation of what will happen. So let's say we want to create a swing high for the 4-hour candle. So I'm just going to delete this 4-hour. Let's imagine this 4-hour, let's imagine this 4-hour candle has not formed yet. So we need 4 1-hour candles, right? So let's imagine this is the 4-hour candle is here. This is the first 1-hour candle. The second 1-hour candle, let's say this is bullish, right? So the next candle, let's say it's bearish. Let's imagine it's bearish. But the wick was very mad. It wicked very madly. The wick was massive. And then the next candle, which is the third candle, since this one closed lower, so I have to open here and then it went up, then closed higher. So with it, just few wick, just a small wick. Now, mind you, the 4-hour candle is yet to be created. What have been created is just the 1-hour, 3 1-hour candle. Now, what have been created is just 2-hour candle. So if you go to the 2-hour candle, we can definitely see a candle printed. Okay, if we go to the 3-hour candle, we'll see a candle printed. And the 2-hour candle high and low will be different from the 3-hour candle high and low, which is the swing point. So this 2-hour swing point will definitely be, 1 hour plus 1 hour makes 2 hours. So on the 2-hour, this is the swing point will be seen as swing high. This swing point will be seen as swing low. On the 3-hour, this is the swing point will be seen as swing high. And this is the swing point will be seen as swing low. Why is this swing point? Because if we combine 1, 2, 3, this is the lowest point. Now, let's now say the last candle opened. And unfortunately, it was a massive candle. that, you know, created funny ways. So this is a, bullish, bearish, bullish, bearish. How do you know it's bullish, bearish, bullish, bearish? Why? Because this one, see where it open from this place, close lower. This one open here, close higher. This one open here, close higher. So for you to know the previous candle, for you to know this candle, if it's bullish or bearish, you must reference previous candle. Okay, good. Now, if we go to the 4-hour time frame, we'll most probably see something like this. See something like this. Most probably see something like this. Okay. So you see that the swing point on the 4-hour time frame is not the same thing as the swing point on the lower time frame, on 1 hour, on 2 hour, or even on 3 hours. You get what I'm saying? But it is still the same theory, the same thing that happens on the 1 time frame swing levels that happens on the 4-hour and even on the daily time frame. I hope you guys we are in sync now. Good. Now that we have understand this swing level very well, now the next question we now need to answer is, Max, how do we now know which is which? How do I know that this swing high is not the real one, so that I can proceed, so that I can continue buying, so that by the time price clears my previous candle high, like it did here, it clears my previous candle high, I don't just start selling just because of there is a swing created. I know that price still wants to continue to buy. And this is where what we call the inversion in the market business model comes into play. We are still building understanding for, what's it now? We're still building understanding for anchor candle. But you can't understand anchor candle if you don't understand all these things. Now we have trash, swing high, and swing low. Every swing would definitely give you a wick. It would definitely, 100%. Because they are all reversal points. Pay attention to that. They are all reversal points. Okay? So now that we understand what a swing is, what makes up a swing, how they differ on time frame, and why, now that I taught you guys VTB, right? Me, the same chat with Max that taught you guys VTB, candle clearing, price clearing previous candle high or low. Sorry, VTB and VTA, yeah, price clearing previous candle high and low, and then giving you VTB or VTA, and then you look for reversal. I'm still the one now that have helped you to see the flaws in that system that you are trading. I gave them to you. Now I'm showing you the flaws. And now that I've helped you understand the flaws, it helps you to better understand that it is not because of that thing is wrong. It's just that there is more to understanding it. Shikina, simple. That is why the market business model, like I said, is a whole, it's complete. The place where there is flaws, there is something that backs it up. So the flaw in what I've taught you based on VTA, VTB is what we are going to fix now. And that is what is going to take us to inversion. Let me check how many minutes I've used. Inversion. Okay, just 33 minutes, so we still have about 20 minutes more. Inversion. Now, what is inversion? Now, in the market business model, there is something we call inversion. Please pay attention. Now we are done with the whole swing of a thing, right? So let's put another line there. In the market business model, there is something we reference to as what? Inversion. Inversion. And that's where we are going to. I just hope everything you guys have been learning so far is entering your brain, please. It's very important. You'll become profitable. Definitely, I'm profitable. Okay, I have records, I have proof of that scattered everywhere. So if you want to be like me, you have to go through what I want you. There's no shortcut. There's no boss. Can we do it like this? Can we? No, there's no shortcut. When you now go through all these classes, at the end of the day, it will yield good fruits for you. So let's proceed. Um, what am I going to say now? How do I explain it? Okay, good. Inversion. In the market business model, there is something we call inversion. And inversion are made up of an inversion is basically a how do I explain this so that you guys don't get confused? Okay, hold on. An inversion means something that is in opposite. Oh, I'm sorry, in yeah, it's opposite, contrary, it's just like something that is in opposite of something. That is what we call inverse. When something is inverse, it means that it is the opposite. So when I say bidders are selling, the inverse of bidders are what? Askers. I'm sorry, askers are selling. The inverse of askers are bidders, right? So that's what we call inverse. Okay, that's where we got the word inversion for the market business model, or contrary in position. Simply put, contrary in position. Now, in the market business model, we see inversions as a, a move in price that hints us to what price wants to do next. And inversion is primarily made up of swing. So you cannot understand inversion if you don't understand swings. Now, let me explain how price moves based on what I've explained to you guys. When I was teaching you guys before we came to technical analysis, I explained to you, I said, in a normal market move, we want to see what? I'm sorry, when you see things like this, you can explain that what is happening. Uh, bidders bidders were in charge, they were in control, they were selling, they were in charge. And then for every time bidders create a new low. I'm sorry. Oh God, my apologies, guys. I'm very sorry for that. It's a mistake. I mean askers, not bidders. Good. So askers were in charge. They were selling, selling, selling. And for every time, remember the law, the definition of bidders is, I'm sorry, of askers. Those askers or ask price is that, askers would always seek low price. Um, Askers will always seek expensive price, and bidders will always seek low price. So somebody who wants to bid or who wants to buy seeks low price, and somebody who wants to sell seeks high price, right? So when bidders start selling, when askers start selling, 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 I don't know why I'm confusing them. My apologies, guys, but please follow up. So when askers start negotiating or they start dropping lower prices, yeah, by the time bidders are okay or they are cool with the price, what happened? They buy back into the liquidity provided by the bidders, by the askers rather. Now, please pay attention to what I want to explain. This is where the concept of liquidity, volume, and volatility now comes into play. When askers were selling, what did they do? They created liquidity for bidders to buy into, right? Good. Now, when bidders finally buys into the liquidity, they will create something we call volatility, massive movement. Why? Because there is liquidity. So the amount of liquidity that is resting at the asker's side The bidders will buy impulsively into them. This is what creates those massive news release. They pump volume. Now, what of volume? The question now is that, Max, what of volume? Volume is now the whole thing that happens between both of them. Now, we cannot see these things, but inversions can help us see them. Yes, this is why the market business model is old. How can we see this volume, volatility, and wherever in the market? Through inversions. So a market is primarily made up of askers creating lower prices, bidders buying at that low price, creating high prices, askers feeling that that price is high enough, and then creating more lower prices, bidders buying into that, and this is what makes up, a swing high, a swing low, a swing high, a swing low, a swing high. The same thing would happen. Remember, price is fractal. So a swing low, a swing high, a swing low, a swing high is simply telling us that bidders were in charge, askers, bidders, askers. Every time you see low price, just know that bidders were in price. I'm sorry, askers were in price. Every time you see price going up, it is bidders move. Every high and every low, there is no low, there is no sell move that is sponsored by bidders. No, every sell move is sponsored by askers. They are the one they want they are selling because those prices are expensive enough for them. And every bidders, they are buying because those prices is cheap enough for them. Regardless where price is, if bidders are not, if bidders still feel like it is okay to still buy, they keep on buying. So the idea of a sell move sponsored by bidders is wrong. You cannot be buying and it will be showing on my record that you sold. It's wrong. If you buy, my record must show that you bought. If you sold, my record must show that you sold. Now, every swing level, every swing low, like this swing low, this swing low, this swing low, this swing low, every swing high, this swing high, this swing high. Remember, I explained swing high for you guys, right? Exactly. And I use candles, right? Good. But now every swing high, every swing high, every swing low, every swing, even in a bullish move, every swing high and every swing low. In a bearish move, every swing high is sponsored by, is sellers. Every swing low is sponsored by buyers. I mean, it's buyers that are buying from there. They are the one that is in that move. Even in a bullish move, every swing low is buyers, every swing high is sellers. The difference between now when we now see price trending or moving in a particular way for a very long time, it's just telling you that volume and volatility is on the side of these guys, not nothing more than that. I know it's rough explanation now. Don't worry, I will explain it. I'll break it down properly for you guys as I used to do. So I'm just giving you a rough explanation. When we start dissecting them properly, you understand them. And I don't care how long it's going to take us. If you understand it, it will be easy for you in the future. So now, these things that I just explained to us is simple. When I was teaching you guys the swing, yeah, and I now brought out and I told us that swing high is made up of this, swing low is made up of what? This. If we now zoom into every swing high, either in a bullish trend or in a bearish trend, whatever you guys call it, it will have this. It will have VTB, volume being transferred, it will have VTA, volume being transferred to askers. And we zoom into every swing low, swing low, swing low, swing low, it will have volume being transferred to buyers. Hope you get. Now, pay attention to what I want you to say next. Very important that you pay attention. If volume is transferred, I'm sorry, in a sell move like this, when you see something like this, hmm, please pay attention. It means that you can buy and make money. You can buy and make money. You can buy and make money. Okay? Regardless that the trend is selling. It means that in an uptrend, you can sell and make money, regardless that it's trending up. This you get. The knowledge is the key. Now let's break it down. Um, how do I explain this so that it doesn't confuse you guys? Because I want to bring in volatility, volume, and liquidity so that you guys don't confuse. I don't want to confuse you. I hope you guys will not get confused. Please pay attention. The dominant price move. When I say dominant price move, it means price going up or coming down. So if price would go up or it will come down, it will need two things. It will need three things: liquidity, volume, and volatility. In hierarchy, liquidity is first. Liquidity means that there must be the need for price to want to deliver up or down. And how do we know that there is liquidity? Through um through what's it called now? Price action. Price action. So when you see sellers in dominant, it means that there's most likely liquidity above that price region. That's why when market open and price starts selling, yeah, and price starts dropping, it's just telling you that price. Remember, based on what I told you in when we were explaining candlestick, that once market open and price starts selling, what happened? It means that there is liquidity above and price is cheap. Price is getting cheap. Price is getting cheap, so we are anticipating bullish move. So whenever there is sell move in this market, automatically there would definitely be liquidity. Are every everybody who is asking, every sellers, remember what I told you, every sellers, the fact that somebody sold here, another person might still think that price would go up a little bit. Remember, askers always want higher price, which means that it's not every ask, and it is not every askers that their orders will get filled. You get? And even those that their orders get filled, it is not all of them that will eventually take profit. Some will break even. Some would, take loss. Why some, their orders will not get filled at all. This is the reason why sometimes when you guys place limit order at, let's say, at this price point, and market goes up, it did not eventually hit your limit order and it continued. Let's say you now forget to close that trade or cancel it, and then bidders now come into control. What happened? They will take you out and you will hit stop loss. How do you guys get? Some of you were able to get in at this point, but you did not take profit, meaning that your stop loss is here. And remember, when I taught you guys stop orders and limit orders, you guys should go and watch those videos. Very important. When I taught you guys type of orders, stop orders and limit orders, and how they are. Whenever you are selling, for you to close this position, somebody must be willing to buy from you. So every sell position, every liquidity point here is an offering for bullish move, for buying. So when price activate, so when you see bidders comes into control, so what I'm trying to prove to you is that there are liquidity, there is just liquidity. We can't see all these things. We don't know. We don't know. But there will always be liquidity. There will always be. The time when bidders will now go and fill those liquidities is what we don't know. But there will always be liquidity in form of orders that are not filled or orders that are filled that are not closed. I hope you guys get. Because price is here does not mean it is expensive enough for people to start selling. Sometimes we look for price to go high, we place our limit order there, price does not get it. And this is the same thing that happens in the market. Every participant, remember, as I told you, every participant is a liquidity provider. $1, $0, everybody in a liquidity provider. So the person who took loss here, somebody have to buy from them. The person who didn't, this trade didn't activate, but eventually when bidders came into control. That is why you see that sometimes you see all this swing level here, all the swing level here. We can't see them. We can't visualize, we can't see them. So all these things, this is a swing. What you guys in a trend market, you guys call this, those trending in a trend, you call this pullback, right? Yeah, pullback happens because price came to a level where there was massive sell orders, right? Massive sell orders, and these sell orders absorb the buy orders, giving a little bit. But the volume, remember, I told us market is made up of three things. For us to know, liquidity, volume, and volatility. And I told us liquidity is the first thing, and now I've explained liquidity for us. Okay, now that liquidity is what is needed for price to go up, in whenever you see sell move like this, for price to go up, liquidity is not needed. And for when you see buy moves like this, for price to come down, liquidity is needed, right? Good. Now for the sell side, is still, sorry, for the buying side is the opposite of what happened in the sell side. Because of price went up here doesn't mean that there are people who don't have limit orders placed here. There are some people who already have orders here safe, and they didn't close, and price comes here and their stop loss is around here, price will take. And when you buy, for your stop order to be activated, your stop loss to be activated, you need to sell back the amount of stuff that you bought at a lower price. So these people are willing to sell what you are, sorry, to buy what you are selling. Okay, so you want to sell, and once you sell, you join the seller. I think in coming videos I will explain this thing I will calm down and use, because this is what makes up order flow. So I'll calm down and I'll explain it, but let's be done with our lectures first. Good. So we are still learning, okay? We're still learning. Now I've talked about liquidity. We are building understanding for what we call inversion in the market business model. Inversion. Liquidity. So liquidity already told us that price would go up. It is when it will go up that we don't know, but we shall know that it will go up. But that is just it. This is liquidity. That is, but the flaw in liquidity is that sometimes price will come up, and then continue selling, just like it did here. Go up, continue selling, go up, continue selling. We don't know. We don't know we don't know where price is heading to. All we shall know is that price will definitely go up or it will come down based on liquidity. Now, how do we know with precision what is going to happen? The next thing is volume and volatility. So liquidity is telling us that there are orders. Volume is now the willingness of Remember, inversion is what? Opposite. Okay? Contrary. Okay? So it's now telling us that a volume would tell us that bidders are willing to start coming into the market. And how do we know? How do we can't see volume too, but the inversion will show us volume. Now, when volume merge with volatility, I'm sorry, with liquidity, something is created which is called volatility. And let me explain that. Liquidity meaning in form of orders, right? Orders. And then volume comes into the market. Bidders bring volume now means that bidders are willing to start pumping and start, buying at every price that is being quoted to them by the askers. Meaning they are bringing in volume. They are willing to. And by the time there is much volume and liquidity, what happens? We create something called volatility. Volatility is impulsive price move. Impulsive price move. Impulsive. Now, let me explain what I've taught to you guys. What I've just explained to you guys is at this high, sellers comes into the market, they sold, creating liquidity above. Buyers bought into where that liquidity by bringing in volume. And this volume creates what? Massive liquidity. I'm sorry, massive volatility. If we want to represent these things as candle, what can we see? We would see a candle open, right? Let's imagine it. Sorry, we'll see a candle open. Oh God, get out. We'll see a candle open. Yeah. Yeah. Askers created liquidity. Bidders bought into that liquidity. So what we will see is the opening of the candle, the low, and then the movement. You see how I've broadly explained. Now you see how everything is now making sense. We are coming back to understanding candle. Now, this low here, what do you think will be here? A swing low. I hope you guys get what I'm saying. A swing low. Now, the question is, since volatility is now in favor, volume is in favor of bidders, what do you think will happen? Price will now continue going up. And what will happen? Whenever you now see a pullback like this, what it is telling you is that they are not telling you, it's not, what it's just telling you is that there were some orders here, because for price to move, people need to buy, right? Bidders needs to buy. So there were some orders here that, people, some stop loss, some limit orders, and, bidders, askers buy into that level. Askers sell, they sold into those orders with liquidity. Okay. And what you see here now is what? Volume high. Swing high. And then price now close for the day. Price might close for the candle rather. Now, this is me representing inversion as a candle. And now, how do we now tell if, the next question now is chat with Max. Now that we know that this is liquidity provided by sellers, buyers buy into them, and then, sellers bring in volume to fill in the liquidity by bidders, and then price close. Now, chat with Max, why is it that whenever price now come and clear this high here, it continues to go up? That is what I want to explain next. And that is still the same thing we call inversion. The same logical explanation. Same logical explanation. Because this here is a continuation. So in a continuation, what will happen now is that price would repeat the same thing that happened here. This is sellers and then bidders filling those orders. The same thing here, sellers creating cheap price, bidders buying into them. But remember that where is volume and volatility? Volume and volatility is with what? Bidders. Now, um, when you see pullbacks like this, um, it tells us that volume is on the side of the sellers, but it's not it's it's not volatile. They don't have they are not willing. Yes, price needs to sell at some point because some people will feel like price is expensive enough for them to start selling, but the majority is not in line with that. The volume comes, if you go to lower time frame, this thing might be a trend and you'll be seeing it as a big volume, which is not wrong. Okay, so it is volatility that supports it. Volatility now is like saying liquidity and volume cooked, volatility exposed them. So we cannot see liquidity, we cannot see volume, we can't see these things. Okay, although there are indicators that helps us understand where volume might be in the market, but in the market business model, we already know those things. We don't use those indicators. We know them. Don't worry, we'll compare them. Okay, so um, so liquidity and volume. Okay, volatility is what now tells us that okay, volume is in favor of this side or this side. Okay, so if in a bullish move, everything I've explained so far, simply put, is that in a bullish scenario, you want to see sellers create liquidity for buyers to buy into, and buyers must buy impulsively. Yeah, and once they buy impulsively, you can be sure that the volume is on the side of the buyers, and whatever sell move you have will definitely go up. In a sell move, in a sell scenario, what we want to see is, sorry, price creating, expensive prices, and then big sellers coming down to, buying into the liquidity created, and it continues like that. Expensive prices, buy into sell into them. Sorry, in a downtrend, we want to see price create expensive prices, sellers feeling that that is expensive enough sold into them, possibly buyers try to come into it, but then the same thing happened, and it continues like that. Volume and volatility on the side of the sellers. Now, with this understanding, if I go to the chart now, let's go to the chart so that I can explain this thing to you guys so that you would understand them. Let me use the 5 minute time frame. Use the 5 minute time frame so that you can get what I'm saying. So I'm going to use a bullish scenario and a bearish scenario. Now, notice that when the daily candle opened, what happened first? Price came down, meaning that sellers already created liquidity. After creating the liquidity, buyers bought into them impulsively. You know, all this buy, 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 buy. That means volume is on the side of the buyers. This hints us at what? At the fact that we can start anticipating higher prices. And then you see this old buy created by buyers. Of course, there are people who would have their stop losses, some limit orders, buy. So sellers came down, but they were unable to go below this level. Okay. We are not paying attention to the level. We're just paying attention to what's happening. I will teach us about the protected level. And then what happened? Buyers, no buyers bought again. Sellers created cheap prices. Buyers bought into them. Sellers created cheap prices. Buyers bought into them. Now, pay attention. Remember, I told you every buy move is because price is cheap enough for buyers to buy. Every sell move is because price is expensive enough for sellers to sell. Okay, so every sell move you see here, you can make your money. Every sell move you see here, you can make your money. Every sell move you see here, you can make your money. In fact, in the market business model, when we get to trading, you will realize that since we understand that price does not have bullish or bearish, it means that we can, in what this guy is called bullish trend, we can even sell and make more money than those who were actually in the trend. A very good example. Is this not a long? Let's imagine, this is a long position. Definitely stop loss zone will be around here. From here to that high. So from this low here, I mean from the entry to that high, to the high of this move is how many? 1:2, right? And the funny thing is that some people might not even close and they might take loss, right? Good. But if you follow the law of based if we, let's say, after I teach you guys, you realize that you can actually sell somewhere here, can actually short, let's say you can short here inside this old move, and maybe you short somewhere here, and what happened? You make your 1:4, still making money more than even people who are in the trend. So in the market business model, we are not trying to understand, the trend or whatever. Our focus is on who is winning. Who is winning? If by the time you come to the market, bulls are winning, follow the bulls. If by the time you come to the market, bears are winning, follow the bears, make your money and move out of the market. The same thing in a sell scenario. Okay, guys, so I will have to end the class here. Yeah, I think I'll have to end the class here. I don't want it to be too long. I'll see you in the next class, okay? Um, that should be tomorrow. Have a wonderful enjoy. We'll start from here, okay? So I'm just gonna stop there.